Hey everyone, welcome back to Corporate Decoder. Today we're diving into Comcast's latest proxy statement, or as I like to call it, corporate word salad. Will we find any hidden gems or just a bunch of boardroom buzzwords? Let's see if their story adds up to shareholder value or just another episode of As the Corporation Turns. This report lays out everything shareholders need to know before the big annual meeting, including who's up for election to the board, what proposals are on the table, and how much the top executives are getting paid. With a dash of legal jargon, Nend Ivia voting guide with a dash of legal jargon. Comcast is bragging about a solid 2024, highlighting a revenue jump to $123.7 billion and a hefty $13.5 billion return to shareholders. They're painting a picture of strong execution and strategic priorities, but let's dig deeper to see if the numbers truly reflect the hype. Revenue did inch up 1.8% to $123.7 billion taverns, but net income attributable to Comcast is at $16.2 billion. Adjusted EBITDA is at $38.1 billion. Revenue increased, but not by a lot, and these numbers are key metrics that determine executive compensation, so it might be worth looking at this closely. Here's where things get a bit more interesting. Their free cash flow is at $12.5 billion. Free cash flow is super important since it is a measure of how much cash the company generates after accounting for capital expenditures and what's left to either return to shareholders or reinvest. Free cash flow is down compared to 2023, but the proxy is mentioning that includes a tax payment regarding the previously announced Hulu transaction, something to keep in mind. The chairman and CEO, Brian Roberts, along with lead independent director Edward Breen, are touting their 6 growth businesses and commitment to change and growth. It's the usual corporate pep talk, but we need to see if this optimism aligns with the actual performance. The board is looking for directors with key attributes like strong leadership, high ethical standards, and a commitment to long-term shareholder interests. Basically, they want smart, honest people who will look out for the company's future, not just their own pockets. When looking at the director nominees, many of the directors seem to have executive leadership, financial or accounting, risk management, and non-profit experiences. These experiences can bring value to the company when looking at its current challenges. The board determined that all non-employee directors are independent, meaning they don't have any major financial ties to the company that could cloud their judgment. They have relationships with entities the company does business with, but they were deemed immaterial. Each director attended more than 75% of board and committee meetings. They also are required to participate in the annual meeting of shareholders so that they can speak for themselves. The audit committee is there to check the books and make sure everything is above board, reviews all the financial reporting, risk assessment, and other critical business operations. The compensation committee sets pay for executives and discusses all succession planning, benefit plans, and human capital management programs. The governance committee is responsible for compliance and monitors workplace harassment, as well as assessing significant environmental and social issues. The report is recommending shareholders vote for ratifying Deloitte as their independent auditors. These are the folks who keep an eye on the books. It mentions the audit fees paid for them are at $30.9 million. It's asking for more shares for the employee stock purchase plan. The company believes it's important to give employees a chance to own stock in the company. This helps motivate them to work harder and align their interests with the shareholders. It plans to increase the available shares for issuance by 10 million, from 24.2 million to 34.2 million to 34.2 million. Here's the big one. Shareholders get to give a thumbs up or thumbs down on how much the top execs are making. It's non-binding, meaning the board doesn't have to listen, but it sends a strong message. The compensation committee thinks they're doing a great job paying the company's executives, mentioning how well they are managing the company for the long term. Let's see if the numbers add up. They're trying to show the vast majority of their executives' compensation is performance-based, saying that 93% for the CEO and 87% for other top executives is tied to how well they perform. They highlight several things they don't do, like not having single trigger acceleration of vesting or paying dividend equivalents. The goal is to make sure executives are focused on the long term and that they don't take unnecessary risks to boost their short-term pay. The short-term incentive program or annual cash bonus includes incentives for the financial goals and also incentives for things tied to stakeholders and sustainability. Looking at the breakdown of financial metrics, adjusted EBITDA, free cash flow, and revenue made up the bonus, each having a 35%, 25%, and 10% weight. There is an additional bonus provided relating to advancing digital opportunity, working on company culture, and improving environmental sustainability. These are qualitative goals. Looking at each of the executives, they are all leaders in their positions and are praised for their roles. This, along with company performance, led to a total achievement of the annual cash bonus being at 109%. However, Roberts and Kavanaugh asked that they not receive any more than 100% of their target bonus, and that's what they ended up being awarded. The company is granting performance stock units and stock options. Each motivates long-term performance of the stock by granting stock options. As they are now in 2025, they intend to grant PSUs only. The performance stock units are dependent on average ROIC, relative adjusted EPS growth, and relative TSR. The ultimate payout can be up to 250%. The compensation committee engages with an independent compensation consultant and assesses all executive compensation, but ultimately decisions are made by the board and committee. The insider trading policies prohibits hedging or pledging company stock, and executives have to own a certain amount of stock in the company. Our current practice is to grant annual equity incentive awards each year on the first business day in March. Looking at the summary compensation table in 2024, Brian Roberts made $33,861,628. Jason Armstrong made $15,163,100, $16,400. Desin Dollery Temtest, $108,000 to $2,127 of Tembi $73,127 for $5. Thomas Reed made $14,127.5. A good portion of the total comp package is provided via stock awards. The table for outstanding equity awards at the fiscal year end shows Brian Roberts holding options for 2,759 6E1 securities and Michael Kavanaugh at 2,177,074. The rest of the executives are significantly lower. Brian Roberts made over $20 million on option exercises. Michael Kavanaugh made over $10 million on option exercises. Brian Roberts has over $145 million in his deferred compensation account, and Michael Kavanaugh has over $41 million. No one else comes close. This table shows what each executive will be entitled to if their employment is terminated. Brian Roberts may receive $83,542 and $622 if this happens. Looking at the total summary of the company's equity plan as of the end of last year, it notes that 28.8 million securities are set to be issued from exercising the instruments, and 341 million securities are remaining for future issuance under the equity compensation plan. The first shareholder proposal is to consider a CEO pay ratio factor. The board is against this. They believe they are in the best position to set compensation. The company says the pay ratio would provide little to no decision useful information. For these reasons, the company is against the proposal. This is to adopt a policy for an independent chair. The company is against this. The company says that the board needs flexibility to combine or separate roles depending on what is best for the company. Overall, based on the proxy statement, Comcast is still profitable, but growth seems to be slowing. This may be why the company is focusing on its dividend to keep shareholders happy, with its planned dividend increasing by 6.5%. The board seems to be very involved with executive compensation, and the company has various compensation plans, but there are no red flags that would suggest this is a bad company. What I'm seeing is a mature company with solid but not spectacular financials. So Comcast is definitely not going bankrupt, but it's hard to get a definitive read on its growth prospects from this report alone. For the immediate future, I wouldn't expect huge gains or losses, but I would be curious to watch how the company is handling these changes over the next 5-10 years. Thanks for watching. If you found this dive into corporate finance interesting, please like, comment, and subscribe for more corporate decoding.